Banking on Wells Fargo, Bank of America, or JP Morgan Chase? They're all components of XLF, the financial sector SPDR ETF, which includes over 75 financial stocks in the S&P 500 to help add diversification and minimize single stock risk. Why invest in a single financial stock when you can own the entire financial sector of the S&P 500? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us on the web at sectorspiders.com.
Higher investment risk leads to higher investment returns, right? It's a Wall Street axiom that we've heard so many times, it's become ingrained in us, and we just accept it for face value. But conventional wisdom and reality have the peculiar habit of departing from one another, and what's happening thus far in 2016 is a noteworthy example of this grand departure. With the year already half over, sexy stocks of the day like Netflix and Tesla and Workday are all underperforming relative to the broader U.S. stock market. In most cases, this underperformance is substantial, but wait, there's more. While the total U.S. stock market has eked out a modest gain for the year, the collective performance of sexy stocks has been anything but sexy. Among the group, SunEdison filed for bankruptcy protection on April 21st, while other companies like Clovis Oncology and Lending Club and Solar City have lost more than 50% in value. Meanwhile, the ho-hum-drum utilities sector is destroying the performance of Group Sexy. Look at the Utilities Select Sector SPDR ETF, ticker symbol XLU, which has jumped more than 18% in value this year, and it continues to defy its detractors. Over the past few years, Silicon Valley types have proclaimed death to utilities due to the rising usage of alternative energy sources like solar power. However, solar stocks have struggled this year because of questions about the sustainability of their business models, along with SunEdison's epic implosion. SunEdison, by the way, was the epitome of sexy because of big-name hedge fund managers that owned it, along with its close ties to Wall Street's underwriters who fueled the company's addiction to debt. There's one last thing to remember, and that is that sexy may look more appealing, but the suboptimal results are haunting. Take a look at this final chart. This shows how XLU Utilities has performed relative to the S&P 500 over the past year. You'll notice that it's outperformed by a very wide margin. XLU ahead by over 23% compared to not even a 2% gain for SPY, which tracks the S&P 500. And boom! It was a great trade for ETFguide premium members because we went long XLU, one of our best trades of 2016, with a timestamp gain of 13%. We exited that in March. We did re-enter a new position in XLU, and again, it continues to outperform relative to the market. Feel free to add to my short list of sexy stocks with unsexy performance. Who did I miss?